Something big is happening, and almost nobody is talking about it. In just 3 months, investors have moved over $40 billion into gold ETFs, one of the largest inflows in years. While the headlines are still focused on tech stocks and crypto, professional investors are quietly shifting toward gold. So what's driving this move? When interest rates rise, holding cash or bonds feels safe. You can earn a return simply by waiting. But that comfort fades when rates stop climbing. And that's exactly where we are now. Central banks have paused their hikes, and the next move is likely a cut. When rates fall, returns on savings and bonds drop too, and investors start searching for assets that hold value even as income falls. That's where gold usually shines. Gold doesn't pay interest, but it doesn't depend on economic growth either. It's a financial safety net that protects value when the economy slows. That's why large funds are buying gold ETFs. They're simple, transparent, and easy to trade. You don't need to buy or store physical gold. Each share of a gold ETF represents real gold held securely by a fund. You can buy or sell at any time, just like a stock. History shows why this timing matters. In 2008, during the financial crisis, gold prices rose more than 20% as interest rates dropped. In 2020, when central banks cut rates to near zero, gold hit new highs again. Those aren't coincidences, they're part of a repeating pattern. When rates fall, the cost of holding gold disappears, and demand jumps. Now, in 2025, that same setup may be forming again. Gold also tends to benefit when the US dollar weakens, which often follows rate cuts. A softer dollar makes gold cheaper for global buyers and adds even more demand. That's why institutional investors are moving early, before the headlines confirm the trend. For individual investors, the lesson is clear. You don't have to buy a lot. Even 5 to 10% of your portfolio in gold ETFs can make a real difference. It's like wearing a seatbelt. You don't notice it when things are smooth, but when markets turn rough, it protects you. Some investors hold gold for the long run. Others use it tactically, raising exposure when uncertainty rises and trimming it when the economy stabilizes. Either way, the goal is the same: balance and protection. Gold doesn't promise fast profits, but it helps keep your portfolio steady through every market cycle. That's why this isn't just a short-term trend. It's a time-tested strategy used by the smartest investors in the world. Add a little gold when others ignore it. Hold it patiently while the crowd chases something else. And when the market shifts, that quiet position could become your strongest one. Gold ETFs make it simple. They're accessible, low cost, and built for moments like this. That's why this really is a simple plan that works. If you found this helpful, don't forget to subscribe. Next, we'll look at how the bond market's comeback could reshape portfolios in 2025, and how it connects to gold's rise today.